We are going to have some polling questions, so if y'all will go ahead and download the polling app, that would be great. My name is Candy Wright, and I am the chair of the PCC, and I would like to welcome you to our private company town hall meeting. This is one of the primary ways that the PCC and the FASB board members get feedback from our stakeholders. It's one of the charges of the PCC by the Financial Accounting Foundation is for us to reach out to our stakeholders to solicit feedback and get input. And so we really appreciate your time and attention this afternoon to fulfill that objective. And we look forward to a very good dialogue. This is not going to be us standing up here lecturing to you. We really need your input and your feedback. So we're really hoping to have a good discussion today. As you notice, there is a part 1 and a part 2. So we'll take about a 15-minute break before we get into part 2. That's just to so everybody can stand up, get the blood sugar up, and then we'll come right back and finish up this afternoon. So I would like to have our panel introduce themselves so that you can know who is up here and who is taking your feedback. So Jim, we'll start with you.
Good afternoon. Jim Croker, member of the FASB. Forward to a great dialogue.
I'm Jeff Bryan with Dixon Hughes Goodman, and this is my 5th year, I guess, on PCC. So always a good conference.
Good afternoon, Sue Cosper, FASB Technical Director.
And hello, I'm Tim Kurt. I'm a Managing Director with Warburg Pincus, a global private equity venture capital firm. I've just finished my first year on private company counsel, and 3 more to go, so interested in all of your feedback.
I'm Harold Monk, member of the FASB and the assigned liaison to the PCC.
Good afternoon. Yen Zhang, a partner at Eisner Amper, a New York-based accounting firm, first-term PCC member.
So with that, we will go ahead and just give you a brief overview of the PCC and what our charge is and how we are structured to give you a level set of kind of how we play in the FASB world and in the standard setting arena. So we have oversight by the Financial Accounting Foundation, the trustees of the Financial Accounting Foundation. We are all selected by that foundation, by the members of those foundations. We have private company practitioners. There are 4 of us. There are 3 users, and there are 3 preparers. And so up here today, Jeff and I are practitioners, and Yen is a practitioner, and Tim is a preparer, but he also is a user because he is in the private equity space, so he kind of plays both roles. So he'll wear a couple of different hats. So that's kind of our makeup today. We deliberate on private company alternatives where necessary, but the one I really want to highlight is the advisory body to the FASB. So as you know, there were several look-back projects that the PCC founding members did and did a tremendous job with and put out some PCC alternatives relating to 4 or 5 of the issues that have been hot buttons for the private company sector for a long time. And so now we have moved into, we're still looking at those where necessary, but we've also moved into our advisory role to the FASB. We're trying to make sure that the FASB hears from the private company sector our concerns and any issues that we might have before the standards actually get set. So the goal is that you would actually see less private company alternatives because they will be embedded in the standards as they are issued. So I really want to highlight that because we may not have a big splash with PCC alternatives like we did when the PCC was first formed, but that doesn't mean that we're not still having real good dialogue and having real good participation by our members and also the FASB board members asking us questions, pushing back on us, and making sure that we come to the right answer for private companies and public companies where it's appropriate.
That's a fist away.
So the differentiating factors for our private company decision-making framework, which is what we use to base all of our decisions on, is on this slide. And so the differentiating factors are the number of primary users and their access to management, investment strategies, ownership and capital, accounting resources, and learning about new financial reporting. So if you were at Kevin O'Leary's session this morning, you heard that he gets a lot of information from his portfolio companies. I think he said he had 40 portfolio companies. So he had, and he called it a seminar or a conference for his portfolio companies where he had all the CEOs and CFOs come to talk with him. So he has real access to management because all of his portfolio companies are privately owned. So that's the access to management that we're talking about there. The modules aren't any different than they've been in the past. And the other thing I want to point out is our charge is to consider cost and complexity, but focus on user relevance. And if you'll remember and think back to some of the comments that Kevin made today about some of the information and the things he needs to know in order to make sure his companies are being managed well and have good financial footings, he needs a lot of information. Some of that he can get through access to management, but some of that is going to come through the financial reporting process. So we have to keep those things in consideration, but also remembering that there is a cost to all of that. So I'm old news, but the new news is Harold Monk. He took Daryl Buck's place as the private company liaison to, from the FASB board member perspective on January the 1st, 2017. And prior to that, Harold was actually on the PCC, so he was one of us. He was a member. So we're thrilled to have him as our liaison, and Harold sits in on all of our calls, all of our meetings, all of our closed sessions to help us from the board's perspective and give us the insight into how they are thinking and what they might be contemplating. And we have new PCC members. As you know, the PCC, our terms are for 3 years. And so the first term of the PCC members ended last year. And with Harold's move to the board, we had actually 4 new PCC members this year. And Yen is actually one of those, so we're pleased to have her with us today, and you can see the others that are listed on the slide. So we have a real good group. We're real pleased with the integration of the new members. It's been pretty seamless. We've started working as a group immediately, so all of that is going, the transition is going really well. So again, really pleased with that. And the one thing also that I wanted to let you know is if you are curious about what the PCC is doing and you want to actually get real-time information, you can go onto the FASB's website on FASB.org, and under the Contact Us button, there is a Stay Connected button that you can click, and you can click to get action alerts, and then in an interest area under that is private companies, and every time we have a meeting or every time there's an alert on a private company activity, it will push an email to you. You don't actually have to go and see that. So it's on the FASB.org website, and I would encourage you to actually go sign up. You can keep tabs on what we're doing. There's minutes on the FASB's website as well that are very detailed, and we do that so that you can understand what the conversation was in the various meetings that we have. So I would encourage you to stay in tune, stay in touch, and let us know what you're thinking if there are issues or things that we need to be aware of. So with that, I'm going to toss it to Jeff to tee up the way the town hall is going to work. Jeff Mechanic, which I did not introduce, sorry, and Michael Chang, FASB staff members, are going to tee up the issues that we're going to talk about today, and then we'll have some polling questions and some we won't, and we're hoping that they're going to get a lot of steps on their Fitbits today because they're going to be running back and forth, handing out mics so that you can talk to us and tell us what you think about these various issues. So, Jeff?
Thanks. Anybody hear me? Anybody hear me? All right, thanks. Good thing I have Michael here. Okay, so yeah, this is one wide room, so I'm definitely going to get some Fitbit, steps here. Anyway, so the first topic that we're going to tee up is clarifying the definition of a public business entity. This project actually was a sister project at the same time that the PCC was being formed and the private company decision-making framework was being created. And the purpose of that project was twofold. One, to try to modernize and homogenize a little bit all the different definitions that we had of public and non-public in the codification that were used and sometimes a little bit contradictory and confusing. And then secondly, key in part of that was to try to figure out what group of business entities were within the scope of the work of the Private Company Council and subject to the criteria of the Private Company Decision-Making Framework. The board issued an ASU, an Accounting Standards Update 2013-12 towards the end of 2013. And what we've had is a couple of questions that have arisen, a few questions that have arisen over the last year or so having to do with the application of this definition. And we thought it was very useful to bring the conversation to you to give you a flavor for the questions we've gotten and the answers that we've given. So on this slide, before I get into the criteria for a public business entity, I want to just highlight what is not a public business entity. And that is in that little gray box on the left-hand side that says that public business entities, or PBEs, must be a business entity. So it doesn't include a not-for-profit entity or an employee benefit plan. And that doesn't mean that the board doesn't look at those to see if they should be treated as public for certain ASUs or non-public for others. It's just that it's a different nuanced evaluation. And for the most part, actually, over the last few years, the board has not taken a public-non-public split in the area of not-for-profits or employee benefit plans. The two main exceptions there were for revenue recognition and leases. So the rest of those criteria A through E, were largely drawn from those 5 or 6 definitions that we previously had. That's really the first 4 of those criteria, A through D. The board did make a few word tweaks here and there. I guess I need to hold this really up. I got to almost kiss the mic. Okay, I'll try to do that. And then criterion E was really a new criterion that was meant really to almost like a belts and suspenders type, what we call at the FASB, a belts and suspenders type criterion, meaning if nothing else was caught by any of the others, and thinking about maybe the markets might evolve a little bit over the coming years, we put it in criterion E. So going forward, next slide, Michael. So we've had some questions, as I said, about a couple of those criteria. Hopefully this is better now. And the first one really is about criterion D. And that had to do with, we used the words an over-the-counter market there, and on an exchange or an over-the-counter market. And there were some questions about, are certain types of what otherwise would be private companies public because they are traded on certain types of over-the-counter markets? And so the question was, what range of over-the-counter markets did we intend to be of the type that would cause an otherwise private company to be public? And we have, and some of the questions were revolved around some of these more dark markets that weren't really open to the general public, but more for qualified investors, as well as certain other types of quotation systems that weren't directly connected with an over-the-counter market or an exchange. And the board, the answer that we've given here is that the board did not intend it to encompass all sorts of different markets. It really intended to be the types of markets that we previously considered to be public markets. So for example, whether pink sheets or the OTC bulletin board, those were the kinds of things that would constitute a public market, those types of quotation systems, but not some of the things that were available only to qualified institutional buyers. So again, the types of markets that we previously would have considered to be public markets are the same types of markets that we considered to be public markets here. And the reason this is important is that some folks were, I think there was a meeting where some of the background papers and some of the discussion led people to the conclusion that anytime a company had unrestricted stock and could be quoted on any of these types of markets, and we're talking about broad types of markets, then therefore it would be public. So there was a lot of concern that a lot of otherwise private companies could have been swept into the definition of public by looking at market really broadly. And again, that was not the intention at all. Okay? So move on to, we'll skip the next slide, really has to do more with those type of quotation systems. The other set of questions that we've had, and this is where we maybe expected a little bit more questions, was about this new criterion, this criterion E, this belts and suspenders, trying to take into account how markets might evolve in the coming years and so forth type of criterion. And that says that in addition to those first 4 criteria, if none of those are met, an organization, a company would still have to evaluate whether or not it's public by looking at whether it has securities that are not subject to contractual restrictions on transfer, basically what we call unrestricted stock, unrestricted securities, and that they are, very importantly, required by law, contract, or regulation. This is not voluntary now. It's actually required by law, contract, or regulation to both prepare full U.S. GAAP financial statements, including the notes, and to make them publicly available on a periodic basis, so quarterly, annually, as opposed to one-off. And where we found, we thought this was largely a belt and suspenders type of criterion, that there weren't many companies that wouldn't meet one of those first 4 that would meet these and meet this one. And what we've heard is that there are some banks that perhaps meet this criterion. I'd say perhaps only because there's at least some of the staff thinks that maybe they perhaps would have met criterion D if you look really closely at criterion D about quoted in a public marketplace and so forth. And so one of the first questions that came to us there was, do the fact that banks have to produce call reports, and those call reports are publicly available information, and they are derived and do reconcile to the GAAP financial statements, does that meet this criterion of prepare U.S. GAAP financial statements and make them publicly available on a periodic basis? And the answer that we've given, and the answers that the regulators have put out in their call report guidance and so forth, is that no, these are not full U.S. GAAP financial statements. They do not include the notes and so forth. However, there have been some banks that do, arguably at least, again, meet criterion E, and those are the ones under the Federal Deposit Insurance Act, and are over $500 million of assets. They are required under FDICIA to prepare and make publicly available audited annual U.S. GAAP financial statements. And so those banks that are under that, that requirement, they would have to determine whether or not they have any unrestricted stock, that's not subject to contractual restrictions on transfer. Because if they do have those, and they are having to fulfill that fiduciary requirement, then those, and if they didn't already meet criterion D, which again was arguable, then they, one way or another, if not D, then E, then they would be considered public under this public business entity definition. One more slide here, Michael, and then we have the polling question. Probably a more nuanced question here that's come to us has to do with a structure that you will sometimes find in the banking world, and that is where an operating bank, put above it is a bank holding company, and the bank holding company has 100% of the stock of the operating bank subsidiary. So the question was whether or not that bank holding company or the bank subsidiary were public business entities, because under fiduciary requirements or the fiduciary regulations, that the bank holding company can file the financial statements, its financial statements, to satisfy that audit requirement in lieu of the operating subsidiary. And sometimes the operating subsidiary doesn't produce full GAAP financial statements. So sometimes, again, the bank holding company is actually is one that's fulfilling that requirement. So the question was, are either of those public business entities? And the answer that we've given is no, neither of them are public business entities. The bank subsidiary, its stock is de facto restricted because all of it is held by the bank holding company. So therefore, there's none of that could be sold out there on the street or over-the-counter market or whatever without going through the bank holding company to buy it. So it does not have unrestricted stock and therefore does not meet this criterion E. Remember, it has to be both unrestricted stock and the making full GAAP financial statements publicly available. And the bank holding company, the answer is that also is not a public business entity because it itself does not have the requirement to produce those financial statements. It's just stepping in and making them available in lieu of the bank subsidiary. So the answer that we've given there is that neither of them are PBEs. I didn't know if anybody out on the table there wanted to add anything to anything I've said before we turn it over for a polling question.
Well, I know that there has been lots of conversation and discussion in our firm about this particular issue as to whether or not our bank clients that are over 500 million would meet that definition. And there was a lot of confusion and a lot of different answers out in the marketplace through industries, associations, and things of that nature. And actually even some publications, I think, from some of the larger firms that would contradict what the answer, that you just went through, Jeff. So hopefully this would clarify that for many of us.
Okay. Yeah, I know some of those firms are the ones that came to us and asked us, those questions.
Just one quick thing I want to add is we audit a number of foreign subsidiaries here in the United States. A lot of them, because of the requirement by the parent company, they have to publish their financial statements, including footnotes, on their website. So we also had a discussion on whether those companies met the definition of a public business entity. And it's important to recognize criteria E. You have to satisfy both requirements. So to the extent those subsidiaries are 100% owned by their foreign parents, they're still not a public business entity.
Right.
So our first polling question, everybody get their iPads and their phones out. Millennials, y'all should be all over this, according to the speaker yesterday. Okay, so the question is, do you believe there are other issues in applying the definition of the public business entity? 30% say, whoop, moving on us. Everybody ready? Uncertain, 39%, yes, 33%, and no, 29%.
Maybe of the 33% that are, if people are willing to
Yeah.
just share some of those, that'd be helpful for us to understand.
Yeah. As well as give Mike and me a little bit of Fitbit steps here.
Yeah, so if those who answered yes, there are other issues, back up one, in applying the definition of a public business entity, if you would mind coming to the mic or waving Jeff or Mike over and telling us what those might be so we can consider those. Somebody brave?
Just need one to start.
Yep, just need one. So Yen said foreign subs was kind of confusing, right, Yen? And you're a large firm and y'all put out guidance yourself on that?
We did, yeah.
So are there smaller firms that are running into issues that you might need some additional guidance on, or something that we can address from either the PCC or the FASB? Yes? Somebody says yes, but you're not exactly sure. Okay, well, we'll come back to it because we're not going to let it go. But we're going to move on, but I'm coming back to it.
One
Yes.
of the important things to keep in mind here, you sort of touched on it at the beginning, is that, mostly you're thinking about this in terms of, can I apply a PCC alternative or not? But because a lot of the new guidance, for example, revenue recognition, leases, credit losses, have different effective dates, it's important to be able to discern whether you are or you are not a public business entity.
Right.
Hence, a lot of the questions from banks, staring at the credit losses standard.
And I will say, there is some additional guidance floating out there. I know that the AICPA, FINREC is working on a white paper, just some implementation guidance, as well as the ABA the American Bankers Association has also issued a different educational type paper.
I
Right.
think this also comes up, particularly as it relates to transition. Even if you meet the definition of a non-PBE, but you have a public business entity that owns an equity stake sufficient to cause them to have to apply the equity method of accounting. So for your standalone financial statements, I think people would say, well, you're a private company, you can avail yourself of private company transition and PCC alternatives, but I do think it causes some interaction with SEC rules and requirements. Sue, I don't know if you're...
Yeah,
They've had sort of evolving views on how that works.
They have. A couple of years ago, when we actually issued the guidance on public business entities, they talked about whether the equity method pickup needed to be, if for a public company, and the equity method investee was a private company, whether that was subject to SEC rules. And at the time, they did say that it was. Now, in December, they gave a speech at the AICPA-ACC conference that talked a little bit about effective dates. And they allowed for dispensation for those equity method investees on the effective dates, but they didn't actually touch upon the issue that they had talked about a couple of years ago. So there does seem to be some confusion out there on that. But notwithstanding, without them saying anything, I would have assumed that what they said a couple of years ago would still stand.
Okay. All right. I guess we'll move on to the next topic.
All right, great. Can't help to notice that, probably because I'm a millennial, it looks almost like Google Chrome. I almost wanted to tap the button and start exploring. So the next topic, I think this group has a love-hate relationship with it. I think I've been here 3 years, and I've talked about this 3 times. The scope has been a little different, I think, each year. But again, I'm talking about consolidations for the 3rd time. Before I start, though, I want to give a disclaimer, especially because I'm talking about consolidations. Obviously, whatever I say is my own view, my own opinion. I hope it's GAAP. I think it's GAAP. But it might not be perfect. It might not be exactly what the COD says, right? So with that, I'll jump right in. So, don't know why it went twice. All right. Well, here are the concerns. I don't think that
Wow.
I'm just...
Okay. Yeah.
Clicking? All right. So here are the concerns with VIE guidance. Probably going to go through it really quickly because I think you all probably understand it, right? VIE guidance is extremely costly and complex to apply. When you go to the codification in topic 810, it seems a little hard to follow, maybe fragmented. And there's not that many examples in section 55 telling you how to apply VIE guidance to situations that are common for private companies. But to talk about VIE guidance and kind of the issues that private company stakeholders have been raising, I think it makes sense to level set. And if you heard this last year, I apologize, but I think this is probably good to at least review. This is kind of how I think of VIE guidance, broadly speaking. So it's a little chart or my cheat sheet. The top 3 boxes that you see really is just asking the question of whether VIE guidance applies. And then the bottom part is who has controlling financial interest, meaning who's the person that's going to have to consolidate or which entity has to consolidate. And again, to level set, you're going to hear some terms, right? So when we say reporting entity, what we mean is the entity in which you're issuing an opinion on or performing review procedures. That's the entity that's preparing financial statements. When we're saying legal entity, what that means is, okay, the reporting entity is looking at a particular entity and it's assessing whether it wants to consolidate or needs to consolidate that entity for the purposes of applying GAAP. Broadly speaking, the first step that you're going to have to address is whether it is a legal entity that you're looking at. Is it a C Corp? Is it an S Corp? Is it a partnership, right? It can't just be an asset or a liability. It has to actually be some type of legal structure within that jurisdiction. Then you're going to have to ask yourself whether any scope exceptions apply, right? So you might be looking at a not-for-profit entity. Well, those are scoped out of VIE guidance, virtually speaking. Sometimes you're looking at it and maybe there is a leasing scope exception, that the PCC alternative, right? That could be another scope exception that would allow you to scope yourself out of VIE guidance. Say you don't have any of those that apply and you're looking at a legal entity, the next thing that you'd have to assess is whether you as a reporting entity have a variable interest in the legal entity. So what's a variable interest? This is where the disclaimer helps, because it's not the exact definition, but it's how I think of it. So a variable interest is anything, a financial instrument basically, that absorbs risk and reward created by the legal entity, right? So what do I mean by that? If I have common stock, that's generally viewed as a variable interest because if the legal entity does really well, the value of my common stock goes up, right? It's absorbing the kind of that reward. If it does poorly, it's going to go down in value. If I look at debt, it's the same exact thing. If the company does poorly, I'm absorbing that risk and the value of my debt that I've loaned out to the legal entity goes down. If it does well, it could go back up, but it usually gets capped out at the principal balance. So it's, again, a financial instrument that I would say absorbs risk and reward created by the entity. So if you have that, then you go to the next step and you're asking whether the entity, the legal entity that you're looking at, is it a variable interest entity? And it's kind of confusing because you've already determined that you have a variable interest in an entity, but it's not a variable interest entity. Because what that question is asking is whether the equity holders as a group, does it really operate the way that you would expect it to operate, right? And one of the first things that you'd have to consider is there enough equity to finance the activities? So is there enough skin in the game from the equity holders to do what they need to do? The second thing that you'd have to ask is, do the equity holders as a group lack the characteristics of a controlling financial interest? And we break that out into the first question. Who has power, right? Is it the equity holders? If they don't have power, then it's a VIE, because you would expect the equity holders or true equity holders to hold power over the decisions that most significantly impact the economic performance of the entity. Second component is basically what I call economic exposure, right? Do you absorb or have an obligation to absorb loss? And the other one is, do you have the right to absorb residual return? If something is preventing you from absorbing risk and loss, you're probably not a true equity holder. You lack the characteristics of controlling financial interest. And there's another criterion that deals with disproportionate voting rights and whether it looks like things are being set up for the individual or the party that has fewer votes, right? That would also trigger a VIE assessment. So basically the way I look at it is, does the entity behave like you would expect it to behave? If it doesn't and you trip one of those things, then you have a variable interest entity. And the next step is basically who has controlling financial interest or who has the primary beneficiary, and that is the individual or the entity that consolidates, right? So that is defined as who has power over the activities that most significantly impact economic performance, and do you break or do you have an economic exposure that's more than insignificant from the reporting entity's perspective to the legal entity. If you do that, you consolidate. Any questions there before we proceed? So that's a brief VIE kind of breakdown. But here's the issue, right? And I think going through that assessment or that flow chart is helpful. So I think this is a pretty common example that was brought forth by private company stakeholders where you have an owner, it could be an individual, it could be a holding company, it could be a married couple right up there. And there's a car company, and the car company makes cars. It's done a very good job. However, in the beginning, it was outsourcing the production of its engines, right? Then the management team kind of came up to the owner and said, hey, I could probably improve your profitability, improve the design of the engines, and what we'll do is create an engine company, we'll design it, build it out, and if there's a surplus of engines, we can even sell it. Owner thought it was a great idea and said, okay, let's start this company. How much funding do we need? I want to get most of this finance. So the owner's like, well, I got 5% of what we need. And the bank said, oh, well, I'll give you 80%, but I need 15% more financing subordinated to, my loan. So the owner tells Carco, you got money. You're going to loan that to Engine Co. There's really no repayment terms, right? That sets the stage. Now, Engine Co. produces engines based on the design specs of Carco. Carco substantially purchases most of the engines or substantially all the engines that Engine Co. produces. Now, you got to go through VIE guidance, right? So, your car company, let's say you're issuing financial statements for Carco. First thing, is Engine Co. a legal entity? Yes. Let's assume there's no scope exceptions and it's not an NFP, okay? Then the next thing is Engine Co. a VIE? The answer is generally yes, because the equity holder, which is the owner, only has 5% in Engine Co., and we're telling you that you probably needed 20%, and that's what the bank kind of indicated, right, to be sufficiently financed. So it tripped up one of the VIE assessments, and it doesn't have sufficient equity. So it's a VIE. Here's the next question, which is where I think a lot of people struggle. Who has power over Engine Co.? Is it Carco? In that case, Carco would probably consolidate, or is it the owner? If it's owner, then Carco would not consolidate. So I think that's kind of the big question, right? Any questions or observations or comments on that so far? Was it? So,
What's the difference between Carco and the owner? It's the same. And I think it's part of the...
Yeah, I think that's part of... I think some people... So the question that was raised is what's the difference between Carco or the owner? Is it one and the same? And I think in some organizations it's one and the same. I think in others there could be some type of separation where the owner has told leadership of Carco what to do, and sometimes he or she comes in and changes the decision making. But it's a tough question to answer, and I think that's why it's hard to assess who has power.
That's exactly the problem.
Yeah.
So that,
right.
Yeah.
It seems like that this is probably, if anything, somewhat of a slam dunk situation. I think you can have all kinds of permutations that make it even more difficult than this fact pattern.
I thought, Michael, the question is, which private company makes cars here in the United States?
Right, so that's probably not, there's probably very few private companies that make cars, but I think the example is easy to understand. You could replace Carco with any other private company, right? And then Engine Co. is just a significant or integral component of the product that Carco makes. That's what we were trying to illustrate. So that's a good question, though. All right, so, there's a question.
Let me go over.
Wait till you get the mic, yeah.
So from a FASB perspective, if we consolidate Engine Co into Carco, do we have the right accounting?
No, I think that was the question, and why you'll...
No, I understand, but
We'll get to the next piece of that, which was, even on the board, we couldn't agree on what the right accounting was. I think it's pretty...
So as auditors, how do we determine it?
So keep listening to the story. That's why we're working on this.
All right.
We'll get there.
So I'm glad you raised that question, and I'm glad it was a great segue to kind of the tentative decision. So that's really what the issue was, right? People couldn't apply it. Board members, staff members, PCC members couldn't really all agree. And here's kind of what the board tentatively decided, because the PCC thought, look, you could probably address consolidations, not just for private companies, but for, broadly speaking, related party arrangements and common control arrangements for everybody that's applying VIE guidance. So on March 8th of this year, here are the tentative decisions. Think of it as like the leasing scope exception that you're probably more familiar with, but expanded. It's a policy election, meaning it's a consolidation policy election once this would become effective. Again, this is tentative, not final. So you'd have to elect to apply this or not. If you do elect to apply it, here's the criteria that you would have to qualify to scope yourself out of VIE guidance. The private company, meaning the reporting entity, and the legal entity are under common control. Okay? The next thing is that the common control parent, or that owner up top, cannot be a PBE, which is what Jeff just walked us through. And then the legal entity, the entity which I'm assessing for consolidation, cannot be a public business entity. So those two criteria are basically new to the scope exception. But what you'll notice is that a lot of the stuff from the leasing scope exception has been removed, meaning there has to be a leasing arrangement. Substantially all the activity had to be related to leasing. And there was also issues if there was a guarantee or if there was some type of arrangement that the reporting entity provided. So it's a lot simpler, I think, to apply. Now, if you do apply this, there are required disclosures, which we'll get into a little more detail. But the principle behind it is basically understanding the involvement and the exposure to the legal entity. That's what is the reporting entity exposed to as a result of its involvement with the legal entity. It would supersede the alternative for scoping leasing arrangements under common control out. And just wanted to remind everybody, in ARB 51, there was and now that's codified in topic 810, there was always an option to combine entities under common control, and that isn't being removed. So you could apply the scope exception, decide not to apply VIE guidance to any commonly controlled arrangements, but if you choose to combine entity under common control, you can still do that. That's still an election under GAAP.
So maybe Mike, tell me if this oversimplifies it, is brother-sister companies, so if you're at that same tier, you got a brother-sister, you don't evaluate each other for consolidation as a VIE. I think it's that simple.
Yep, it's that simple.
Outside of VIE guidance.
Yep.
So you still follow voting interest, but obviously if you have voting control, it wouldn't seem to be a brother-sister, it'd be a parent-sub relationship. So if you're on the same brother-sister tier and you're a VIE, you don't even have to figure out, am I in the VIE, am I not? If you elect the exception, you don't evaluate it for consolidation. You do have some disclosures of the relationship between the entities, including, the guarantee, much of which would have been required already as related party disclosure. So it's to say, here is the nature of the transactions between the entities.
Yep. And I'd say if you're like me and your eyes glaze over whenever you get into VIE guidance, this gives you really, and you want to present substantially the same thing without having to, get into justifying what your VIE is and who's the primary beneficiary. I think the ability to provide combined statements really gives you the flexibility to do it either way you like. And, I think this, in my mind, is one of the better examples of how the FASB is really listening to the private company council and really cares about issues related to private company application of really complex standards. And I think, my own personal view is that this, the leasing exception was a really good first step in this process, but the idea of potentially expanding that into a whole set of other issues under common control really is quite helpful and really a great reflection of the FASB's responsiveness to this.
Yeah, I agree with all those. It's probably we've probably spent as much time on this as anything over the last few years. I think that we heard from users that, and as we've experienced, sometimes you'd have to have the combining or consolidating information in order to meet user needs. Sometimes there was over-consolidation for various reasons, and the over-consolidation can be less meaningful than failing to consolidate somebody. But I'm particularly pleased with where we are. A year ago at this conference, I said that Mike had been trying to teach me for 3.5 years on VIE guidance, and that through no fault of his own, I was going to, it hadn't sunk in. I was going to spend the next 1.5 years on PCC learning as much as I could about the VIE guidance. And then as I rolled off of PCC and retired, I was going to forget everything I knew about it. So this is advancing my ability to forget about everything that I know.
There you go.
I'm not trying to be difficult, but as a practitioner, what do we tell our clients? I mean, combined, consolidated doesn't sound right. I mean, the banks don't understand it. So do we tell the client we just use the word consolidated and not combined in that situation? Well, no, but let's say we have all the consolidated. Let's say we have other. Let's say that in this example in Engine Co, there's other subs of Engine Co, or Carco. So we have several subs. So we have to do consolidated financials for Engine Co, and now we have for Carco, and now we have Engine Co. Do we call it consolidated, or do we use combined consolidated?
You wouldn't consolidate. You have an election to combine if you want to.
No, but I already have a consolidated Carco. I have subs under Carco.
Through voting interests.
Right,
So you have it through a voting interest ownership percentage.
Yes.
So those subs would continue to be consolidated, but Carco would not consolidate Engine Co, period.
That's if you choose the policy election.
Right.
So if
Thank you.
in your circumstance you think it's better reporting to run the model, and you believe it should be consolidated after you run the model, then you can.
But you have the option to get out of trying to get through to figure out if you should consolidate.
But I think it also provides you with the flexibility if there are a number of companies within the organizational structure that are common control. You don't have to go through the VIE process and determine whether or not they need to be consolidated. If a particular user or a set of users think that this really should be combined, it provides you with that flexibility to do so.
Yes.
First of all, kudos to the PCC. I think you really have listened to us, and I think this is a great outcome. I particularly like the notion of being able to present combined financial statements. We have clients where we previously, or up to now, have had to present them as consolidated and present the VIE's equity as non-controlling interest, which users have a real hard time understanding. My only question is the bullet about the legal entity is not a PBE. I'm curious as to why that matters. That's the VIE, correct, which would always have the ability to issue standalone financials even as a subsidiary. So why is that criterion necessary to this proposal?
So I can try to answer. So the question was why is the legal entity, why is there a requirement for it not to be a public business entity? I think some of the justification that the board had for determining who could be a PBE or not is they realized that, look, in public company arrangements, generally things are spelled out, it's contractual. So doing the VIE assessment's a little easier. Not saying that it's easy, but it's a little easier. Whereas you look at private company arrangements, a lot of times there's nothing written down, right? So I think the thought is if the reporting entity and the legal entity, if one of them is public, then there's more likelihood that there could be something written down. So I think it's the distinguishment of having things formalized versus not formalized.
So it is an area, because we talked about the complexity, and I've spent most of my career working in sort of the public company space, worked for a while at the SEC, but this is an area that public companies and their auditors don't understand any better than, I do, and I have Jeff's problem. I may understand it by the time I retire, and hopefully I can forget it. And I personally question whether we went far enough. I actually wondered whether we should have a private company alternative or not, meaning all companies might avail themselves of this election, public or private. We asked that question in the exposure draft. I think we asked questions about the scope, including, should we limit it if one in the structure is a PBE. If we don't ask that question specifically, I comment on it anyway. We are going to reorganize the codification to make it easier for all companies, have some other things, but it is an area that's equally challenging, although, obviously the financial reporting abuses that occurred in the public company space caused some reluctance to extend it that broadly.
Understood. I was just hoping if I take a bullet away, it simplifies it further. I can see a situation where a commonly controlled entity has debt securities that make it, say, a conduit debt obligor. In those circumstances, the users, the debt holders, would not have access to consolidated financial statements of the primary beneficiaries. So it just doesn't seem like a necessary requirement. Thank you.
So maybe we have one more question.
But we'll go over here.
When the PCC put out the guidance about doing away with VIEs for leasing companies, a lot of our clients pushed back on us and said, we're going to keep consolidating our leases because our bankers are used to it now. Mm-hmm. We can't go to them 1 year and say they're two separate entities, go to them another year and say, no, they're a VIE, and go back to them 10 years later and say, no, they're not a VIE now. So now you're asking us to, I think this is great. I think this is brilliant on a go-forward basis. What I would like to see from the FASB and the PCC is that you all think about these things before you put out standards more proactively. Not for nothing. If you got two well-known gentlemen up there who go, well, hey, I don't know if it's a VIE in that situation or if it's not a VIE in that situation. We don't understand VIEs either. Well, then what's the poor practitioner to do?
Right.
Okay, so
I'm a practitioner too, and I feel your pain. So that is what we're trying to do. When the PCC was established, that is what we're trying to do. We did the look back, and now we really are focused on going forward, trying to get our input in, and trying to think about things before the standard gets.
We got revenue recognition coming up. We got leases coming up. That's going to be tremendously expensive to our private companies. Okay, it's a little off topic from this, but
we'll get
they
to
use
that.
QuickBooks. They use small who haven't adopted their software yet. And we got to implement this in 6 months in order to have comparative financial statements.
So we'll get to revenue recognition and leases. Let's get through the VIE discussion, and then we'll circle back because there's several questions on that. So we will touch base on that. Did you
One
have
thing
something?
I want to mention is when your staff or partners or clients hear that the leasing option has been withdrawn, the only reason is because it's embedded now in this new standard, and it's just expanded that essentially. So it's still there, even though it will indicate that has been withdrawn.
So the Technical Issues Committee, as you guys know, is a big supporter of this alternative. And what we did talk about in Norwalk back in September was just potentially having guardrails in place to prevent structuring, because we have some TIC members that are concerned about some of their clients maybe doing things a certain way just to avoid the rules now, and structuring would still be there, that opportunity. So I was wondering if that was still on the table to maybe introduce some guardrails in this final proposal surrounding that issue.
We talked about guardrails, loosely used word term, when we were developing the standard, but quite frankly, it added a lot of complexity. And so in some instances, you might say that the guardrails are the disclosures. And the disclosures will provide the information on what a company's doing. It'll be heir apparent if you're structuring.
So to Sue's point, we were struggling with, the idea was you can't figure it out, so what would the guardrails be? It would be effectively coming up with a new VIE model. I'm not sure that VIE model would be any easier than this one, but certainly in the public comment, if people have suggestions of, if this now will introduce the ability to abuse consolidation rules, what would the solution be in a highly structured transaction?
Okay.
All right. Jim, you mentioned in the comment period, I don't know, Mike, have you said exactly where you are in the process?
That's the next slide.
Oh, okay.
All right. So, kind of a recap, because you've probably heard this topic so many times. So, prior to the meeting last year for this town hall in April, basically, the PCC raised the issue and asked the board to discuss it. In November, so basically the end of the year, in November, the board looked at it, researched the issue, and decided that they kind of had this tentative scope exception, but wanted to kind of walk through it with experts in a consolidations roundtable, which took place in December 16 of 2016. They got enough feedback, came back to the table after a holiday break, and then on March 8th, tentatively decided what we just discussed. And then most recently on May 18th, they dealt with some sweep issues, decided that they would like to move forward and expose this. So I think the exposure draft will be coming maybe the end of June, early July at the earliest, but it could be even August. And then there would be, I think, a 75-day comment period. So definitely, if this is an issue that's near and dear to your heart, which I can definitely sense that, I would definitely comment on it, whether you support it, don't support it. But
would be an exposure draft to comment on the PCC's position to then be advanced forward to the FASB?
So just...
Is it a FASB exposure draft?
This is a FASB proposal, but we got feedback from the private company council on it.
It was on our agenda, and when we discussed it in the April 2016 meeting, we decided that it probably could be solved more at the board level versus a PCC alternative, and so it's going to actually be a FASB standard, not a PCC alternative.
But it really did come from
It did.
the PCC, and part of the reason I think, Candy, is at one point we were talking about whether this should be for all companies, public and private, and so the board said, well, we want input on that. So effectively, I would say we, took the work of the PCC, takes one step out of the process, but the PCC should really get the credit for being the engine behind, getting
we pushed it up.
The board's attention on this.
I think the other thing to keep in mind is that if you were at one of the morning sessions, you heard Harold talk about the proposal, and there's a few other things that will be included in this proposal. So it makes sense that it's sort of all together.
Okay, let's go to the polling question.
Let's say that car company does not adopt the alternative. Is car company required to consolidate because it's a VIE?
It would have to go through the VIE guidance to determine whether or not it is a VIE. If it chooses not to elect the policy exception.
But we just went through the guidance, and I think we agreed that we don't really know for sure whether it's a VIE. What I'm concerned about is
that's a good reason to
they
adopt
the guidance, and so they don't consolidate, and then they go public 2 or 3 years down the road.
So
then wouldn't they have to make a decision whether they had followed normal GAAP?
So I think, and Mike, correct me if I'm wrong here, but one, you'd probably need more facts that are on this page to figure out, does car company have control? But what we what we realized is people can't, to the question, 10, 15 minutes ago, how can you distinguish the owner from the car company, particularly in a private company arena? I think there's diversity in practice today. Some would reach the conclusion they consolidate, others wouldn't. I personally, give Mike's disclaimer, don't take my, what I say as GAAP, but I personally think that diversity is fully supportable because the literature doesn't answer that question. It's one of the reasons private companies likely would take the alternative. And part of the reason I think Mike talked about was because in a private company context, the governance documents around separate legal entities aren't the same as what you would expect if you're raising public capital. So I know it's not a satisfactory, this is the clear answer, but I think that diversity that exists is understandable, and hopefully this helps companies not have to wrestle with that.
Yeah. All right.
Okay.
So here's a polling question.
I think you have to go one more, Mike.
Do you want to read it, please?
How should the board address concerns with applying VIE guidance to private companies under common control? A, private company accounting alternatives not to apply VIE guidance to companies under common control, which is the board's tentative decision. Clarify existing VIE guidance. Other, and then uncertain. So, get your... No votes. Here we go. So it looks like number A, the board tentative decision, 83%, 84, is in agreement with the direction that the board's going. So, okay.
Wow. Very few uncertain responses. That's interesting.
Good
All right.
job educating, Mike.
Oh, all of us. So.
And the other.
All right. So, we talked about the disclosures, and as I promised, or trying to keep myself honest, we will dig a little deeper on what those disclosures are. So first off, you will have to provide the Topic 850 disclosures, right, because this is a related party, which you probably know better than I do. If you deal with private companies, that's one of the biggest issues that you are probably facing every day. But if you apply this alternative, this is what you're going to have to disclose with the legal entity under common control. So it would be the nature and risks associated with the legal entity under common control. If you go back to our example, the legal entity would be Engine Co. So what are the nature and the risks associated related to Carco with its involvement with Engine Co. How does the legal entity affect the reporting entity's balance sheet, financial performance, and cash flows? So being involved with it, how does it affect the financial statements that we're all familiar with? C, the assets and liabilities that are on the reporting entity's balance sheet resulting from its involvement. So if you go back to the example that we're looking at, that would be the 15% loan from Carco to Engine Co., right? So obviously you need to disclose that. And then D is kind of what's the maximum exposure that of loss that could be related to the legal entity because of its involvement. So is it just a loan that they shelled out money for, or could it be more? Is there an implicit arrangement where you would have to spot the loss for anything that could come in Engine Co.'s way? And that's going to take a lot of judgment, but I think that's something that would be, or that is going to be required to be disclosed. Criterion E, or disclosure E, is basically if that maximum exposure is greater than what you have on your financial statements, you're going to have to provide information to allow a user to understand what that excess exposure is. So what is above and beyond what I have on my books from the reporting entity's perspective? So what's above and beyond that loan? And to reiterate the point, you have to consider both explicit arrangements, so that's going to be the easy stuff that's written down. But the harder part is probably the implicit arrangements that may exist. So any questions on that?
Mike, would you talk about maybe what's going to be in the ED relating to the disclosures, whether or not there'll be examples and guidance?
Oh, yeah, that's a great point. So in the exposure draft, with all guidance actually, common feedback that we have from private company stakeholders is you issue guidance, and there's very few examples. Within this exposure draft, there is actually a disclosure example on how you would probably meet the criteria, meet the disclosure requirements when you're applying this accounting alternative, and it's with Carco and Engine Co. So.
Mike, the other question I have for in the exposure draft, whether that's also going to sort of redefine term entities under common control.
Okay. So that's a great question. So the question again is, what's common control and are we defining it? No, we're not touching the definition of common control. Some history on that. The EITF tried to explain it because it's important for BizCom accounting. It tells you if you're under common control, you get carryover basis. If you're not under common control, you get the step up for fair value. the EITF wasn't successful. I think that they had a lot of problems. I think the problem has only gotten worse today. So I think to not stall progress, they didn't decide to define what common control is.
But they give examples, right?
Yeah,
So
I guess.
Go ahead.
I guess I've been known for raising that question from the very beginning when we were going to have a ASU issue that said VIE guidance for entities under common control. That was very pronounced in the standards title, that we don't have a definition of common control. The EITF did try to go through, and they gave some illustrative points as to when entities might be considered to be under common control, and they were a pretty limited set of criteria, if you will, some of which may apply and some of which may not be applicable in the private company environment, but you're going to have to look at it, I think, from a policy decision, if you will, from a firm. We oftentimes have entities that are owned by people that nobody controls it. They're under common ownership, not common control. Some of them are related and some of them are not. And so it's going to put a little bit more stress, if you will, on the definitions as to what is common control.
Jeff, I agree wholeheartedly with what you said, and I just want to make an analogy a little bit. I mean, I'd say common control is one of those things where you're better off saying you know it when you see it as opposed to being very prescriptive. I think one of the things that you can look at the VIE guidance as and say, you know, the VIE guidance was really very prescriptive and very technical and you know, hard to understand. And, you know, one of the things that I'm appreciating about the standard setting process is that it's not a perfect process, and that, you know, as it relates to this, you know, improvement, I think, you know, taking 80% of the way towards improving GAAP for entities under common control, you know, I share the frustration of why isn't VIE guidance simpler to apply in the first instance, but I think this, you know, this is really an attempt to get in the right direction, and I think, you know, I'm happy that most of you are in agreement that this is progress. We should be happy with progress, but not so happy that we don't continue bringing up the places where it's annoying and we sort of need to get to the right answer. But I think, you know, taking it as a step-by-step process and getting and taking progress and acknowledging it, and then going back and fighting is a good way to go.
Tim, I agree with that, and to me it's the constant battle between, if you want bright lines about what common control is or isn't, we can give them to you. I can guarantee you won't like the answer, because we're going to have to make calls about whether grandchildren are under common control. What about these types of relations? What about great-grandchildren? If we have to draw a boundary somewhere, we can make it clear. It just won't allow the flexibility that I think Tim talks about to say, you know it when you see it. And that is I don't mean that in any sort of way other than it's a constant battle to figure out when should we make the lines clear versus allow that judgment. And I think this is one area, just my guess would be, you're probably better off making those calls about, is the substance of this common control or not?
Question in the back?
Yes, so before I ask my question, I do want to state that I'm very supportive of the direction that you're moving on this. I think this is a terrific step in the right direction. That said, putting myself into the shoes of my private business owner clients, the excuse that they've given for to this point in time, at least the large bulk of them, is that they don't like the VIE determinations to junk up their financial statements, and so they've taken a GAAP exception and they just don't do it. The change that you're proposing to make here is going to keep that information out of the basic financial statements, but it's going to put an awful lot of information into disclosures. And as I'm envisioning the discussions with my private business clients, I'm not sure I envision them taking a different position necessarily on this. I'd like to know your reactions to that.
So I've actually thought about that same comment as well. And I think, you know, when you think it through, you may end up in the exact same place, with a gap departure because the disclosures are not in the financial statements, and you don't want to go through the cost of auditing the disclosures because you will have to audit the disclosures, so you actually could end up in the same spot. I still think this is the better way to go, and users that we have gotten feedback from are comfortable with disclosures being in the back and still being under GAAP. And so I think that's kind of the compromise that we landed on.
To me, that one is a little bit of a struggle because, and I don't know how long the illustrative example is. It's not very long, but these are the kinds of things you would think a lender or others would want to know. What am I interacting with this? What is my exposure to risk? What is that sort of maximum potential? What assets and liabilities do I actually have on my books? I mean, those aren't things that could be. These are, what are my actual receivables from related parties? What are my payables to related parties? So it's hard, and again, it's open to comment, and if we have improvements, let's get those, but at least initially it was hard for the board to think about, if we're not going to do consolidation at all, shouldn't we at least make sure the related party nature is clear?
And, and I've been a CFO of a firm that takes a gap exception for not complying with consolidation requirements, but we still have lots and lots of related party disclosures in our financial statements. And independent of whether this applies or not, our auditors would insist upon that disclosure, and they would be right to do that because I think users of our financial statements deserve the disclosures that are sort of proposed.
All right, so next thing is the polling question on these disclosures. And we, I think, heard some of your thoughts so far, but I guess officially we'll put on the poll.
So, do the proposed disclosures requirements adequately provide information about a reporting entity's involvement with and exposure to a legal entity? Yes, no, or uncertain. Okay. Looks like we are about 80% yes. So in agreement that the disclosures should give the users what they need to know about their exposure. Okay.
Would anyone that said no like to clarify or add to that? And are we missing something?
Or too much?
Or too much?
Yeah, too much. No one?
I was going to comment, owners is really going to be on the practitioners, because I can just envision several of my private clients will probably use 20 words or less to cover or try to cover all the disclosure requirement. Doesn't matter how comprehensive the example is going to be in the EDs. I think really the challenge will be the auditors to say, whether you actually quantitatively and qualitatively describe everything that you need to disclose under the standards.
Okay, so we are at 4:36 and we're supposed to break at 4:40, and our next topic we have a lot of questions on, and I think we're going to have a lot of discussion, so I think it'll be wise if we take our break now, 15 minutes, and y'all come back in 15 minutes and try to be on time, because we really do have a lot of feedback that we want to get from y'all. So get up, stretch your legs, get the blood sugar going.